to first spot a break of structure. Then, look at the starting point before the sharp price move which led to that break of structure. The area right before the sharp move upwards is called a demand zone. Similarly, in a downtrend, the area right before the sharp drop that led to that break of structure is called a supply zone. Returning to our original example, since we've already identified a break of structure, finding the demand zone becomes easier. We look at the area right before the sharp move that led to that break of structure. In this case, price began its sharp move upwards at this point. To mark the demand zone, highlight the last candle right before that sharp move. Use the rectangle tool to draw a zone from the candle's low to its high. This marked area becomes our demand zone. Now that we've identified a demand zone, we move on to step 3, which is finding a liquidity level, and this is the most important step in the entire strategy. To put it simply, liquidity levels are areas where a lot of stop-loss orders are placed. Examples of liquidity levels are double bottoms, triple bottoms, or even multiple rejections from the same level. The point is, when a level looks too obvious for a bounce, a lot of traders enter long positions there and usually place their stop losses just below it. This causes a buildup of liquidity under that level, which becomes a target for stop hunts. So what we're trying to find is any type of liquidity level that's located above our demand zone. What usually happens is that price will break below that level, sweeps the liquidity below it, and then bounces off our demand zone. This bounce becomes our long opportunity. The same logic applies in a bearish structure. What we're looking for is a liquidity level that's located below our supply zone. What usually happens is that price will break above that level, sweeps the liquidity above it, and then rejects off the supply zone. And that rejection becomes our short opportunity. Now back to our original example. Since we've already marked our demand zone, the next step is to find a liquidity level sitting above it. And here, we can see that price formed a double bottom, rejecting the same level twice, which creates a pool of liquidity below that level. Once a liquidity level is identified, we move on to the final step, which is entering the trade. Entering the trade with this strategy is simple. We place a limit buy order on top of the demand zone, place a stop loss slightly below the zone, and set a take profit at 2 times your stop loss distance. Or if you want to be more aggressive, you can target the previous highs as your take profit. Now, a limit order means you're not entering the trade at the current price. Instead, you're entering at your desired entry price, along with your stop loss and take profit targets. This way, you don't have to sit in front of your charts all day waiting for the entry. Simply set a limit order and let the price move. In this example, price actually broke below the liquidity level, wicks into our entry, and then reverses back up, hitting our take profit target. Now, this strategy might seem hard at first, as many conditions need to come together for it to work, but it's really just about spotting a few key rules. A liquidity level formed near a supply or demand zone. It's no different than trying to spot a regular chart pattern. For example, in a triangle pattern, you're not trying to find this exact price movement, because price don't move like this in a real chart.